inflation, we have economic growth. So we have, as a whole, we discuss the entirety. So what we are going to do is to start with them, breaking them down. We have the government being the consumer of the picture of macroeconomics concept. We have businesses that are big. We have engineering projects that can run for years. We have industrial development. So this analyzes the way the larger thing, the influential. We are no longer looking at the issue of buyer seller, but we are look at even policies made by government, how they impact on this. So macroeconomic view overview, we have things that are called indicators, and those one are the ones that influences used to measure. So the first one, we look at the GDP, gross domestic product. And then we look at the, somebody just left the class. Then we look at the national income. We have inflation rate, we have unemployment rate, and then we have economic growth. So let us uh, delve down and look at other things that are falling under this macroeconomics. We have the aspect of circular flow of the economy, uh, one of the simplest microeconomics model, where we have the banks and we have those people who work, the households, and then we have the government. So what happens here is that we have one person who is the household, and then we have another person who is the producer, the farms. So they produce goods and services. The household has the role of consuming, and at the same time they can be producing as farmers. Farmers produce, but in every process that is going to happen, we have the impacts of the external factors. If it is the farm and if it is the farm and the rest, we could say that if it is the farm and the consumer, or the farm and the household, it could be a micro level, but now macro has impacts on the banks. Now the banks helps us with capital, so investment, and when we make sales, we take back money to the banks, we save them. Then we have the government. They look at your business, they issue taxes, they tax the products that you are selling or consuming, and then there's government spending for the services that they are giving you. So we have those people who think big, and they need specialized machines, maybe from China or somewhere else. So those people, they go to imports, they give away money and earn technology or something else. So import, they export some money and import a solution. So they create something that impacts the macro scale. So we say households supply labor and receive wages, and then farms produce goods and pay that one. So the households spend money, income on goods. This nature of spending, this one, leads us to taxes and so on. When they go to the bank, they have to pay for interest. So we have national income and output. A minute. So the national income and output refers to the total income earned by factors of production in an economy over a given period. Usually 1 year, that is July to the next year, June to July. Is it true? June to July to July, June to, I think 12 months there. So this one represents the economic performance of a country. Then we have major income measures. We have number one, gross domestic product. This total value of goods and services produced within a country for a given specific period, 1 year. So GDP can be calculated using three approaches. We have a production or output method, we have income method, we have expenditure method. Then we have two, gross national product, GNP. It is not much talked about this one unless you are. So this one measures the value of goods and service produced by citizens of a country, regardless of where production occurs. In our country, we don't use this because no one even knows that we will ever make profit. But the gross domestic can be is mostly used. So we move to three, net national product (NNP) is obtained by subtracting depreciation from GNP. So you forget about this part. It's a repetition. You just take GNP minus depreciation and you get the answer. And then we have national income, refers to the total earning of all factors of production in an economy. So this includes wages, rent, interest, and profit. So you can visualize this, but I want to tell you, you see those three, the four of them, pen and paper. I think you people know what it means, pen and paper. It will harass you somewhere. So if you don't take note of that, you will get it somewhere and it will be something new. So take note of that. We can move to these are just diagrams. When you are reading on your own components of national income, what is macroeconomics, you just understand this. So GDP is formally expressed as a formula, and that formula is shown here. Don't forget this formula, good people, because it is a formula that expenditure is used to look at the GDP. So the first thing is that you take the consumption, food, everything, clothing, and then you add it to investment, machinery, equipment, factory infrastructure, and you add it to government spending on roads, schools, hospitals, and security, the defense. And then you add to the difference between exports and export. So you take this and you subtract this so that you see how much did we make after giving out money to foreigners. So you say whatever was imported is reduced from the export so that you don't mix money. Don't mix money. So we have input and output analysis. In an economy, we have to study the relationship between industries that exist within that. So that analysis has some history, and it was developed by somebody called Wassily Leontief. Uh, you can see that there was a Nobel for that. And since that one was so, it shows how the output of one industry becomes the input of another industry. That one is input-output analysis. Whatever is being produced here can be beneficial to another sector. I hope you are getting that. So then we move to the input output table. Here we have agriculture, and then we have manufacturing, and then we have services. The sector, we say agriculture, so you you draw this here, you draw this here, you draw this here, and you draw this here. Each cell represents the value of input supplied from one sector or another. So you see the value stands for input. So in agriculture, agriculture gives itself 20, it gives manufacturers that, it gives this other part 10. Manufacturing gives agriculture 40 that way. So it means uh, uh, it shows how the output of one industry becomes the input of another industry. So if you look at the input analysis, a type of microeconomic analysis, uh, you move to from this side to studying interdependence between multiple industries of an entire economy. This is a definition. If you ever come to define this, it says a type of microeconomics carried out to study the independence between multiple industries or sectors of an entire economy. I think these one are just for you to gain further and understanding, but just know that the input of one sector is going to be used in another. Uh, Forget about this, it doesn't help for our case. So we have industrial interdependence. Since we have input of another industry being important in another, it means there is mutual dependence of industries on each other for outputs. For out inputs and outputs. For example, if you are in a construction industry, you will see or you will encounter that one product produced by another is consumed by the other one, and it goes on and on. You look at the steel industry produces, it goes to construction industry, transport industry, it moves things. Even energy, it is the same thing. So from that, you have to understand the importance of industrial interdependence. It helps economists and planners forecast economic growth, analyze industrial policies, understand supply chain relationship, plan infrastructure development. So these ones you will read on your own. So we come to national income calculation. If you have a problem like this, you look for the formula of calculating GDP. I told you this. Once you understand this formula, you feed in values from here, and you know these values are in billions, and then you get your answer. Pen and paper for that. Pen and paper for that. Then you do this question, define, do this, define. Pen and paper for that. Pen and paper. Pen and paper for that. So for that case, we can now move to chapter 5, development economics. In the case of development economics, it is a branch of economics that studies how countries improve their economic condition and living standards. So when they want to say Kenya is developing, we have to look for strategies that promote economic growth, uh, industrialization, reduces poverty. Politics actually increases poverty, so it is a strategy also when it comes to economic or development economics. We have improved quality of life, and we have so many others, even the adoption of technologies being having informed people in the leadership and people being or developing a positive mindset like the people of Japan. They have a mindset that looks like an economic model where people just know that we should grow. So while traditional economics mainly studies production, market behavior, developing economics in this case looks for the long-term structural changes in an economy, industries, education being improved, and healthcare. We have infrastructural development. We have technological progress, and this one. So you pen and paper this, and it will help you. So we can move from that and jump to economic growth versus economic development. You should be able to differentiate these two and understand that economic growth refers to increase in the total output of goods and service in an economy over time. When, when you look at the GDP, GNI, national income growth, they tell you about the economic growth. Then we have economic development, which now tells us that improvements in the quality of life and economic well-being of the people, quality of life and the well-being of the people. So pen and paper, pen and paper, pen and paper. So when you want to look at that, we've repeated this. This point should be able to sink. It's just that we have added technology here. So when you compare the two, you should be able to differentiate it as such, and you will be able to earn good marks. This is another differentiation. This one is short term, this is long term. So make sure you look at this, you look at that. So we have model of economic development dimension. Look at that diagram. Development always comes with sustainability. So we have empowered society, quality education being offered, economic growth is being part of the development, and accessibility of accessible quality health. So we have the society, education, economy, and health. These things are very important. You can look at the dimension. We have indicators, and then we have dimension index. For example, a long and healthy life. People are aging in Japan, and their life expectancy is good. It's an indicator, and then we have life expectancy index is like 80 years and above. So when you go to education, when you go to education, you have knowledge, adult literacy rate, and then we have gross enrollment ratio to school. It is using education index. Then we have a decent living standard of living. Indicator is the GDP per capita, and this is the GDP index. Then all these are measured by looking at the Human Development Index. We will still look at that in future in the coming chapters. So there are three-dimension framework of visualizing things. We have the economy here. we have the society, and then we have the environment. And when you look at that, the environment, we will be able to assess the technology, the things that are happening. And then when it is in the society, we look at the development of that society. And then the pockets, economics of the pockets, the income growth. Then you look at this PNP, we have industrial development. The other one was economic. So under economic, we have industrial development, expansion and modernization. Manufacturing is growing. We have industrialization. Things are changing. So all these have a major role that is linked to the industries. What are the industries doing when we have industrial development? They are building capacity. They are increasing production capacity. They are employing more people. They are reducing unemployment, and they promote technological advancement. And this thing of export becomes a factor now. So industrial development has some stages. It's first start with the agriculture being stable, producing raw material, and then we move to industrial economy now changing, and then we have services now. It when Kibaki developed the country, it reached a point when people are just asked to read and they will get jobs. So industries were built. Right now, it looks like the economy is going back to where skills are needed. We are going back to two or three skills. The same thing I think it was happening in 80s, late 80s, and all along to 80s, all along to 90s, and then it was damaged. So politics is an evil thing. So it changes the model. So we have importance of industrialization. It creates employment. It increases productivity, export expansion, technological innovation. So pen and paper, good people. Pen and paper can surprise you in exams. So I want to see. Meanwhile, you can drop your admission numbers. We are midway. There are graphs that are there. You can look at them later. We can look at the economic planning. Refers to the strategic process by which government allocates resources to achieve national development goals. You've seen this. Most of you have seen budgets are being read. People are being given money, and even those who are given money, they appear as if they have not been given money. It's very complex thing. Maybe people need more to steal. If there's no way we can be able to feel the economy